All right, well, we have markets rebounding this week with the S&P and NASDAQ each up more than 3% and on pace for their best week since November. We have Sandy Pomeroy of Neuberger Berman here with us. Sandy, thanks for joining the conversation. We were just talking to Scott Gamma, reporter down on the floor of the New York Stock Exchange. He was talking about the 2,800 level in the S&P and saying now traders aren't talking about 2,800 since we've passed it. Now it's where are we headed next? Where do you think the markets are headed from here?
That's an interesting question. I think it sort of deserves a little bit of a recap for context. And I think what had happened is during the latter part of last year, many of the Fed's tightening actions, both from shrinking the balance sheet and also raising interest rates, started to bite in the real economy. We saw auto sales start to slow. We saw evidence that housing was beginning to slow. All the credit-sensitive sectors were beginning to slow. And I think that what we saw in the fourth quarter, when you layered the trade war concerns on that, you really saw the evidence that earnings were going to come in less than people thought if we continued to stay that course. However, the Fed began to rethink its policy, and what we have is a situation that is not nearly as tight as it was back, when we were in the summer. So the question in my mind is, with the Fed actually finally, becoming less tight, are we actually going to see the economy reaccelerate? And I think that's the key thing to watch here. If the economy reaccelerates, I think the market can keep going. And if we stall to some extent, I think we've captured most of the good news.
Do you think we're headed towards another dangerous melt-up? And look, we had almost $26 billion flow into U.S. equity funds through March 11th. So the retail money is now coming back into these markets. What's your sense of this?
My sense is that typically happens in the beginning part of the year because 401ks are funded and whatnot. So there always is a bias in the beginning of the year to having more flows go into products. The more they go into passive products, the way that we've seen, that pushes up certain groups of stocks. I think the better opportunity now is to find the ones that might have been left behind, where you might have a unique story, where earnings are going to surprise on the upside, or they have other characteristics.
Any examples?
On where we might see earnings
value,
surprises.
like untapped value?
So I think one of the opportunities that our team's looking at right now is in consumer discretionary, for example. We're going to get tax refunds coming, or they've started, and we're going to continue. If the economy reaccelerates, the job picture stays pretty decent, we think that that's an area that could do much, much better. And there's so much negative feedback from the whole e-commerce thing, and there have been a number of retailers like Foot Locker, for example, which we own in the portfolio, that we think has the potential to surprise earnings on the upside.
They put up some good numbers.
They did put up some good numbers. It could be just the beginning. So,
Sandy, so I want to take it a little bit overseas just for a second. So obviously the markets today, not today, this whole week, pretty much shrugged off a lot of these global headwinds, U.S.-China trade, but particularly Brexit, which was my big interest. How insulated do you think U.S. equities are to what's happening over in the U.K.?
Well, the UK is a little bit of a unique story. Now, the question is does a Brexit actually create so much chaos in the European markets that it drags the whole European economy down? And I think that's just, we're going to have to watch and see how that plays out. It seems to me that cooler heads are going to prevail here, and that there's going to be a compromise. It's just that we're bringing it to the brink before that happens. I'm more concerned, actually, with what's going on in China. And I think one of the key considerations here is when the Fed was being very tight, that actually forced very tight monetary policy on China. And we saw evidence that China was beginning to slow a lot. And that slowdown is causing all the ripple effects throughout the Asian markets. Now that the Fed is gone on hold, this could be a more positive story for China, particularly if we do end up seeing some sort of relief on the trade front. So I think these are all very fluid things that we have to be following, and we can position, I think the best way to be positioned route is balance in the portfolio, because I think you could still have some bumps here for the next quarter or two until we're clear that there's a reacceleration of earnings.
Sandy, how do you think the markets will react to a trade deal? Are we talking about 0.5% rally, a 1% rally, or do you think the markets could really take off if we do see some sort of resolution?
So I think that there is resolution priced in, and that's part of the snapback that we've seen. So I think that with all these things, the devil's in the details, and you have to see how companies are going to be particular beneficiaries or hurt by any specific deal that's presented.
All right, well, Sandy Pomeroy, thank you so much for stopping by.
Thank you.